are appreciative that this is an attractive asset class they would love to get exposure to, and if one mega trend is in the public security side, the adoption of ever more passive instruments, the other mega trend we see in finance today is a growing appetite for private market fund exposure amongst both institutional and private investors, and so there is demand for private equity, private debt, etc. But there are challenges. It's not trivial how to get that exposure. So up until now, you've had questions around concentrated risk as versus diversification. You've had constraints around ticket sizes, so the minimums required to invest into an index, such. There is the question of just being able to find and source and screen and diligence and choose which fund you're going to do. It's a heavy resource, and there's a lot of science, and there's also a lot of art to being able to pick which is the best funds. One of the things that we talk about often in class, and there's a lot of academic research about this, is that amongst private equity funds, they may have a good, consistent track record and history of performance, but on a relative performance basis, who's the so-called top quartile? There is there is a lack of relative performance persistence, meaning, put simply, if your last fund was top quartile, statistically, you're pretty much just as likely to have your subsequent fund be top, second, third, or fourth quartile. And if your last fund was bottom quartile, you're also just as likely statistically to have your subsequent fund be a top, second, third, or fourth quartile. So using the past track record in a scientific way to try and analyze that and based on that determine the future potential of making a further investment with the same manager is really difficult. And so that's where I think these challenges can be addressed and have a somewhat of a solution that will make things a little bit easier for investors to get exposure to private equity without the same risks, with less volatility, with a much easier approach to how they can build that exposure. If they are very constrained on their resources, capital, human, and other, they can use an index as a one-stop shop and just buy the index. And if they have a deep bench of resources, then they can go about it with a core satellite approach. Just like in public markets, we've seen this is a way to improve your optimal portfolio construction. And the core could be either our private equity type index, which is just the broad diversified exposure across the entire asset class. So you get more than 70% of the asset class each year. And then your satellite might be a manager that's giving you a lot of co-investment and you're reducing your gross to net fee spread, or it's a niche manager in a small part of the market, etc. And it could be the flip. It could be that your core holding is you continue investing with some of the big managers and put down substantial ticket sizes that get you discounts on fees and those co-investments. And then your satellite is niche areas of the market that you might not have the resources to go and explore, such as the new emerging energy transition space within private markets. And you go